Now, Aaron, great information. But can we go back to the question? What's determining mortgage interest rates?
The supply of capital going into the mortgage-backed securities as those go up. So that in fact, I can kind of zoom in on that just a little bit more here to determine on a day-to-day basis what drives it, so it gives a little bit more color to it. I showed you that big ass chart and I told you about all these other things, but I didn't get into how does that translate to actual interest rate. So
yeah, and what is and so I'm sure there's something that's driving money to this investment as well, right? I know you're talking about the supply and demand, so maybe talk about what's incentivizing people to invest in mortgage-backed securities.
Well, we'll definitely get into that. So every single one of these lines here that I'm showing you, the green ones and the red ones, represent 1 day's worth of trading. So as somebody, let's say right here, this day, for some reason, I can't remember what it was that happened. I have to go back and look at my research and my notes. Economically, something happened that drove a significant amount of capital into the mortgage-backed securities, right? And they bought into that day. And then you see them continue to buy into it. Then you see some sell-off days. So where it starts low and ends up high, that means it was money going into the security when it's a green candle, right? The red candles mean it started higher and went lower because they sold their positions. They got out of it. Why they would go into it is because economic data looks like inflation is probably more under control. When it looks like inflation is more out of control, they get out of a long-term instrument. So think about the time value of money. I talk about it a lot. If you're getting something, you're locking in a cost. When you buy into this, it's a bond. It's a fixed return for 30 years. And if in that 30-year window, what they're paying you back with is going to be worth more in value down the road, then it's a great thing to lock in for 30 years, right? If I locked in something for 30 years, you're going to be paying me back, and what you're paying me back with has an increased valuation, then I'm doing better. But if it's a decreased valuation, then I'm losing by having bought into the security. So the higher inflation goes, the more people want out of bonds, because we're buying into something that's going to be long-term. Inflation's going up, meaning the dollar's worth less. And the only reason inflation goes up is because there's too damn many dollars chasing too few items, right? So you're getting paid back less and less and less the longer it takes. So they don't want a person really to ride this thing out for 30 years. So it's attractive place for people to park capital while you have more volatility somewhere else. So you'll see bonds moving positive when things are negative, very negative in say equities, because of how volatile it is. But what we got going on in equities, there's a lot of pumps out there, people pumping up valuation of stock. It's amazing how you can have companies that are making huge returns in their stock, but their actual day-to-day is not generating any revenue at all. But it's a company value because of what it represents, not what it actually creates. So it's a very, very interesting economy. I don't see great reasons to go into mortgage-backed securities other than they've got to park capital somewhere that's going to make some sort of return while they're determining where else to put the capital. And you're talking about like hedge funds or pension funds or things like that. Large chunks of capital sitting somewhere. It's got to be put somewhere working. Sitting in a bank account is not making you anything. Going over here making 5.5%, because that's what this coupon is a 5.5. It's a hell of a lot better than going into a bank account making 0.01. So that's one of the reasons they go into a bond, because it's a set rate of return. And they got to move that money out there into the mortgage, out in mortgages and out into people's houses, so they can pay those returns and the bond not fail.
Okay, so a lot of times people put a lot of pressure or emphasis on the quarterly Fed meeting and where they're raising rates. How or does that affect the price of a mortgage?
It affects it in the sense of how it affects inflation.
Okay.
So as we were just talking about, inflation it erodes the bond's value, because if inflation is going up, the dollar's losing value. Whoever's holding it for 30 years is making less money because you get paid back with an instrument that's declining, which is the reason why you want a 30-year fix, because you're making money as somebody else is losing money. So when the Fed meets and say, hey, we're going to raise interest rates, what it does, it increases the cost of everything out there, whether you're a bank, whether you're a person consuming. Therefore, it's supposed to slow people down from buying things. The more expensive it becomes, the less you're actually going to buy it, right? So if you walked into your favorite restaurant and you love their ribeye, Yeah, you're okay with spending $100 on your ribeye because it's only be once every few weeks, right? But if you got the ribeye that's sprinkled with gold dust, which I've seen that stupid ass thing on a menu, and it's $800. Now, are you going to buy that? No, it's the same damn ribeye. It's just sprinkled with gold dust. Somebody just says you want to just ship gold. Fine. You might feel good about yourself for a half a minute, but it doesn't have any value, right? So it's kind of the same thing. Is they're trying to increase the cost of things to a point where people are like, we can actually go over here. In fact, they have an index when they factored in the CPI, the consumer. They had a replacement index factored into that consumer price index. Where, a person might have a lifestyle where they eat steak this year, but the next year maybe they're going to go to chicken because things are a little bit more expensive. And then that next year, maybe not chicken, maybe they go to ground beef, right? They have a replacement index. They can still fill their belly with, whether it's 6 or 8 ounces of meat, but it's a different meat. So we can not really factor that cost into the consumer price index. And therefore, the inflationary factors that we've been given are wrong because of that replacement thing. But they're still attacking people spending money as a whole by increasing rates and increasing costs. And right now, I know for them to try and even continue to keep attacking it, they're attacking jobs. They've got to get less people working, so there's less money in the economy, less money chasing things, shrink the inflation back down to a manageable scale.
You want to see the entire episode? Click here. If you want to learn how investors use infinite banking to increase their returns and lower their taxes, click here. If you want to see if infinite banking is for you and you have some questions, hop on a discovery call with us and one of our coaches. The link for that will be in the description.